Hello students and welcome to EPG Pathshala. I am Dr. Shefali Nagpal from Bhagat Phool Singh Mahila Vishwavidyalaya. Today we are going to talk on the module Foreign Exchange Market under the paper International Business Operations. The objective of these lessons are to provide you with a comprehensive description of the nature, structure and operations of foreign exchange market, to describe the types of foreign exchange transactions and the major participants of foreign exchange markets, as well as to understand the foreign exchange quotations of the Wall Street Journal. The foreign exchange market. It is a market in which foreign exchange transactions takes place. In other words, it is a market in which the national currencies are bought and sold against each other. In the words of E.V. Evatt, it is a section of economic science which deals with the means and methods by which right to wealth in one country currency are converted to rights to wealth in terms of another country's currency. It also involves the investigation of the methods by which render such exchange necessary, the forms which such exchange may take, and the ratios or equivalent values at which such exchanges are affected. The foreign exchange market in terms of value of transaction is the largest market in the world with daily turnover of around 2 trillion US dollars, and it is a 24-hour market. Defined as exchange of money or credit in one country for money or credit in another. It covers method of payments, rules and regulation of payments, and the institutions facilitating such payments. Foreign exchange market. Foreign exchange market refers to buying foreign currencies with domestic currencies and selling foreign currencies for domestic currencies. Thus, it is a market in which the claims to foreign monies are bought and sold for domestic currency. Exporters sell foreign currencies for domestic currencies, and importers buy foreign currencies with domestic currencies. According to Ellsworth, a foreign exchange market comprises of all those institutions and individuals who buy and sell foreign exchange, which may be defined as foreign money or any liquid claim on foreign money. Foreign exchange transactions result in inflow and outflow of foreign exchange. Now let us understand what is the nature of foreign exchange market. Foreign exchange market is a decentralized market in the sense that market participants are generally separated from one another, and the transactions that takes place through the electronic media such as by telephone or through computer networks. Two implications of decentralization are fragmentation and lack of transparency. The foreign exchange market is fragmented in the sense that transactions may occur simultaneously or near simultaneously in the market at different prices. It is opaque or it lacks transparency in a sense that the absence of physical market place makes the process of price information interaction difficult to observe and understand. Although the market is decentralized, it nevertheless has various physical locations or trading centers throughout the world where many of the most important market participants, particularly in the market making dealers, tend to concentrate. Now let us understand what are the functions of foreign exchange market. Foreign exchange, as it is referred to, forex market, foreign bills of exchange, telegraphic transfer, bank draft, letter of credit, etc., are the important foreign exchange instruments used in foreign exchange market to carry out its functions. The foreign exchange market performs the following function. First is transfer of purchasing power or clearing function. The basic function of any foreign exchange market is to facilitate the conversion of one currency into another. That is, payment between exporter and importer. For example, Indian rupees is converted into US dollar and vice versa. In performing the transfer function, variety of credit instruments are used, such as telegraphic transfers, bank drafts, and foreign bills. Telegraphic transfer is the quickest method of transferring the purchase power. Another function is credit function. The foreign exchange market also provides credit to both national and international organizations to promote foreign trade. It is necessary as sometimes the international payments get delayed for 60 or 90 days. Obviously, when foreign bills of exchange are used in international payment, a credit for about 3 months till their maturity is required. Another function performed by the foreign exchange market is hedging function. A third function of the exchange market is to hedge the foreign exchange risks. By hedging, we mean covering of foreign exchange risk arising out of the changes in the exchange rates. Under this function, the foreign exchange market tries to protect the interest of the persons dealing in the market from any unforeseen changes in the exchange rate. Hedging guards the interest of both exporters as well as importers against any changes in the exchange rate. Hedging can be done either by the means of spot exchange market or a forward exchange market involving a forward contract. Now, let us see who are the participants of foreign exchange market. The foreign exchange market consists of two tiers, the interbank or wholesale market, and other is the client or retail market. Wholesale foreign exchange market. The major foreign exchange trading in the wholesale foreign exchange market is undertaken by banks, which are popularly known as interbank market. In this market, bank and non-bank financial institutions transact with each other. They undertake trading on the behalf of customers, but majority of the trading is undertaken for their own account by proprietary desks. Besides bank and non-bank financial institutions, multinational corporations, hedge funds, pensions and provident funds, insurance companies, mutual funds, etc., they also participate in the wholesale market in the foreign exchange. Then, foreign exchange dealers and brokers. The role of foreign exchange dealers and brokers need to be discussed in detail. But let us first understand who foreign exchange dealers are. Dealers are the bank and some non-bank financial institution which act as foreign exchange dealer. These dealers quote both bid and ask for a particular currency pair, that is for spot, forward and swap contracts, and take opposite side to either buyers or sellers of currency. They make profit from the spreads between buying and selling prices of the currency, that is the difference between bid and ask rate. Brokers are agents which merely match buyers and sellers and get a brokerage fee. Before the internet, the brokers, dealers and clients were communicating over telephone or telex or through satellite communication. SWIFT, which is Society for Worldwide Interbank Financial Telecommunication, facilitated the communication between these brokers and banks. These dealers are also known as market maker. As market makers, these dealers stand willing at all the time to buy and sell currencies at quoted rates. Now let us understand who are brokers. Brokers, on the other hand, help clients to get a better rate on currency trade by making available different quotes offered by dealers. Traders can compare rates and accordingly take a decision. Brokers charge a commission for providing these services. Communication between brokers and clients also used to be through dedicated telephone lines. A broker continuously remains connected to the dealers to get latest quotes, depth of the market. The broker compares the rates offered by the dealers and provides the best rate to the clients. That is, highest bid prices quoted by different dealers when the client wants to sell and lowest ask price quoted by different dealers when the client wants to buy. Now let us also look at the participant in the commercial and investment transactions. Importers and exporters, international portfolio investors, multinational firms, tourists and others who use the foreign exchange market to facilitate execution of commercial or investment transactions. Some of these participants use the foreign exchange market to hedge foreign exchange risk. Speculators and arbitrageurs seek to profit from trading in the market. They operate at their own interest without a need or obligation to serve the client or to ensure a continuous market. Speculators, they seek all of their profit from the exchange rate changes, whereas arbitrageurs try to profit from the simultaneous exchange rate differences in different markets. Arbitrageurs buy and sell the same currency at two different markets whenever there is a price discrepancy. This principle of law of one price governs the arbitrage principle. Central bank and treasuries. Central bank and treasuries use the market to acquire or spend their Central banks and treasuries use the market to acquire or spend their country's foreign exchange reserves as well as to influence the price at which their own currency is traded. In many instances, they do best when they willingly take a loss on their foreign exchange transactions. Foreign exchange brokers. Foreign exchange brokers, they are the agents who facilitate the trading between the dealers without themselves becoming the principals in the transaction. For this service, they charge a small commission and maintain access to 100 of the dealers worldwide via open telephone lines. It is a broker's business to know at any moment exactly when dealers want to buy or sell any currency. Retail market. In the retail market, the individuals like tourists, foreign students, patients traveling to the other countries for the medical treatment, small companies, small exporters and importers, they operate. Money transfer companies or remittance companies, for example, like Western Union Money Transfer, are the major players in the retail market. Retail traders buy and sell currency for their genuine business or for their own personal requirements. For example, an exporter enters into a forward contract to convert foreign currency to domestic currency. A tourist buys the foreign currency in the spot market before undertaking a journey. A UK patient visiting India to undertake an operation that would have cost him a fortune at United Kingdoms. Transactions that takes place in interbank markets. Transactions in the foreign exchange market can be executed on a spot basis, forward, future options and swap basis, which are discussed one by one as follows. First, let us discuss about the spot transactions. In the spot exchange market, the business is transacted throughout the world on a continual basis. So it is possible to transact in foreign exchange markets 24 hours a day. The standard settlement period in this market is 48 hours. That is 2 days after the execution of the transaction. The spot foreign exchange market is similar to the OTC market for securities. There is no centralized meeting place and no fixed opening and closing time, since most of the business in this world is done by banks. Hence, transactions usually do not involve a physical transfer of currency, rather simply bookkeeping transfer entry among the banks. A spot transaction requires almost immediate delivery of foreign exchange. In interbank market, a spot transaction involves the purchase of foreign exchange with delivery and payment between the banks to take place, normally on the second following business day. The date of settlement is referred to as value date. Another is outright forward transactions. A forward transaction requires delivery at a future value date of a specified amount of one currency for a specified amount of another currency. The exchange rate to prevail at the value date is established at the time of agreement, but payment and delivery are not required until maturity. Forward exchange rates are normally quoted for value dates of 1, 2, 3, 6 and 12 months. Actual contracts can be arranged for other lengths also. Outright forward transaction only account for about 9% of all foreign exchange transactions. The basic objective of the forward market in any underlying asset is to fix a price for a contract to be carried through the future agreed date and is intended to free both purchaser and the seller from any risk of loss which might incur due to fluctuations in the prices of underlying assets. A forward contract is customized contract between two entities where settlement takes place on a specific date in the future at today's pre-agreed price. The foreign exchange rate is fixed at the time the contract is entered into. This is known as forward exchange rate or simply forward rate. Swap transactions. A swap transaction involves the simultaneous purchase and sale of a given amount of foreign exchange for two different value dates. The most common type of swap is spot against forward, where the dealer buys a currency in the spot market and simultaneously sells the same amount back to the same bank in the forward market. Since this agreement is executed as a single transaction, the dealer incurs no unexpected foreign exchange risks. So, swap is a private agreement between two parties to exchange cash flow in the future according to a pre-arranged formula. They can be regarded as portfolio of forward contracts. The currency swaps entail swapping both principal and interest between the parties, with the cash flow in one direction being in a different currency than those in the opposite direction, there are various types of currency swaps like fixed to fixed currency swap, floating to floating currency swap, and fixed to floating currency swaps. Future. It is a contract which provides a simultaneous right and obligation to buy and sell a particular currency at a specified future date, at a specified price and a standard quantity. In another word, a future contract is an agreement between two parties to buy and sell an asset at a certain time in future at a certain price. Future contracts are special type of forward contracts in the sense they are standardized exchange traded contracts. Options. Currency option is a financial instrument that gives the option holder a right and not the obligation to buy or sell a given amount of foreign exchange at a fixed price per unit for a specified time period, that is, until the expiration date. Or in other words, we can say a foreign currency option is a contract for future delivery of a specified currency in exchange for another currency in which buyer of the option has to right to buy, which is called call, or sell, known as put, a particular currency at a agreed price for or within specified period. The seller of the option gets the premium from the buyer of the option for the obligation undertaken in the contract. Options generally have lives up to 1 year. Majority of the options traded on the options exchange have a maximum maturity of 9 months. Longer dated options are called warrants and are generally traded at OTCs. Let us look a glance of comparison of forward and future currency contracts. On the basis of various parameters like size, delivery date, method of transaction, participants, margins, and maturity, there are differences in the forward and the future currency contracts. On the basis of size, forward contracts are structured as per the requirement of the parties and future contracts are standardized. On the basis of the delivery date, forward contracts are tailored on the basis of individual needs, whereas future currency contracts are again standardized. Method of transactions in the forward contract is established by the bank or broker through electronic media. But in the future currency contract, it is an open auction among the buyers and sellers on the floor of recognized exchange. On the basis of participants, forward contracts involves banks, broker, forex dealers, multinational companies, institutional investors, arbitrageurs, traders, and similar. And also in the future currency contract, they also involve banks, brokers, multinational companies, institutional investors, small traders, speculators. So students, let us now summarize what we have learned in this module. The foreign exchange market, it is a mechanism by which a person or a firm transfers purchasing power from one country to another, obtains or provide credit for international trade transaction and minimizes exposure to foreign exchange risk. A foreign exchange transaction, it is an agreement between the buyer and a seller, that is, given amount of one currency is to be delivered at a specific rate for some other currency. A foreign exchange rate is the price of a foreign currency. Foreign exchange quotation or quote is a statement of willingness to buy or sell at an announced rates. The foreign exchange market consists of two tiers, the interbank or wholesale market, and the client or the retail market. Participants include banks, non-banks, foreign exchange dealers, individuals, and firms conducting the commercial and investment transactions, speculators, arbitrageurs, central bank and treasuries, and foreign exchange brokers. Thank you.